This week we're going to look at the high yield market, in particular the US high yield market, and consider whether it still offers value to investors in asset allocation. Just before we do that, just want to have a look at a brief history of what has occurred in the market. Over the past 20 years, the spread has averaged just a tick under 600 basis points. More recently, we saw it pick up quite sharply in the early part of this year to around about 850 basis points, one standard deviation above the average, but it has since rallied as expectations of recession have been unwound. So currently sitting closer to around about 640, 650 basis points. So in this short session, I want to investigate, one, is this fair value, and what is it saying that the implied probability of default is, and also is there any information about what it's suggesting the likelihood of a recession might be, and whether we think that is correct or not. So to investigate this, we want to first just remind ourselves that the high yield spread basically incorporates two components, one of which is I guess an illiquidity premium of around about 3% on average over the past 25 years. And the remainder of it reflects a default loss premium, which is a function of both the probability of default and the loss given a default. So two components make up that spread in our view. So a simple model will give us some sort of idea as to what the market is currently pricing in. So current spread, as we can see here, it's about 6.5% over the Treasury. And that's suggesting, based on a model that uses that liquidity premium of 3 and a recovery rate of 0.4, it suggests an implied default rate of around about 5.8%. So what does that actually mean? Put that into context. Well, if we look at the long-term average, the default rate is closer to 4.2%. The current default rate has been around about 3.335. So it's an implied default rate in the market at the moment of about 5.8 is a considerable pickup from where we have been over the past few years, and also over the 20-25 year history. We should also remember where it came from. Back in January, February, it got up to about 850 basis points here, which was suggesting or implying a default rate of around about 9%. Now, default rates of around about 9% tend to be associated with recession, or at least very close to recessionary periods. So if we just go back now and have a look at a chart that looks at implied probability of default, and that's the blue line. So there's a time series of that model that we were just referring to, and the red line or the pink line is the speculative grade default rate from S&P. So it's kicked up, as we said, to 3.5%, yet the implied probability of default is sitting around about 6. So the long term, so a couple of observations to make. One, during recessions and the recessionary periods here, we can add those in. I'll just do that very quickly. They're the recessionary periods. So you've seen the default rate move up to around about 10% in the early 2000s, and then of course in 2009 to the 10 it ended up getting to around about 11%. So as we just suggested, with spreads up around about 850 basis points, almost pricing in a very strong likelihood of a recession. In fact, if we go down to this table below, just to quickly explain, recessions tend to have an average default rate of 10%, and outside of recessions, the default rate tends to be, around about 2 to 3%. Let's call it 2%. So if the market was correct, and with a spread of around about 850 basis points, which is there, based on a very simple model of recession suggesting a 80-90% probability of recession almost being implied. Now that's on the basis of that liquidity premium being 3%. Of course, we can make adjustments for that, but basically with 850 basis point spread, the market was implying a probability of recession anywhere between 50 and 100%. So very high likelihood of recession. If, however, the belief was that the likelihood of recession was closer to 20%, and that's what the current reading from the Atlanta Fed is suggesting, then the appropriate spread would be around about, or the appropriate the expected default rate would be about 360 basis points, and a fair value spread closer to 520 basis points compared with the current 650. A key consideration then is looking at the default rate and also an indicator of the likelihood of recession in the US. So that's what we're doing here. The shaded area is the previous two recessions. The red line, pink line is the US GDP-based recession indicator index, and yes, you can see there it has picked up. Of course, during the recessions, it got to levels of 95 and around about 85 back here, and the blue line, as mentioned, is the default rate. So we have to ask ourselves whether the default rates that we're seeing at the moment and that the market's implying are suggesting a much higher likelihood of recession. So let's now consider what the current valuations suggest for high yield. So one way of looking at value within high yield is to compare the implied probability of default on a standardized basis and compare it to the recession index. So we might take the view that if the implied probability of default is way above that as being suggested by a recession indicator index, then value might emerge in the sector or in the asset class, and it should present stronger returns over the period ahead. So we can actually test that. So I'm looking at the Merrill Lynch total return index, annualized returns over the next 1 month, 3 months, 6 months, 1 year, and so on and so forth out over a period of time. And I've chosen periods where the implied probability of default is quite high relative to the current readings of the recession index. So just to show you what that is suggesting. So this is looking at the deviation of those two. So it's at relatively high levels at the moment. The higher ones here in the shaded areas are where the market is pricing in quite a high probability of default relative to the actual recession index. So let's have a look at that. What does that mean for returns? And if we just press that, evaluate, what we see above is the top line shows the returns when this has been true, compares it to returns in all other periods over different time periods, and it's just trying to determine whether this seems to be a different distribution of returns, and also shows the difference in the mean returns of both of them. So it's showing that yes, it would appear that the subsequent returns over the next 3 months, 6 months, a year, 2 years, and even out to 3 years tend to be high, quite high and positive for high yield in situations where the spread is high, or the implied probability of default is high relative to the recession index. So that's probably no great surprise, but that's where we saw ourselves going back in February, March. Now we tend to be sitting in this second quintile, which is not as clear cut. In fact, the returns under that condition compared to all other conditions is very similar. So not a strong signal right now. Now, just to go back in time and just to finish up with a look at the high yield and some valuation indicators. So what we do here is we're looking at the implied probability of default. That was a measure that we were just discussing. Give it a score when it's in a certain quintile, and also just look at the raw implied probability of default and give it a score. So what we're showing here is the green bars is the signal, a valuation signal for high yield. So when it's high, it means certainly, if it's up around these levels, it means potentially both of those indicators are on, i.e. implied probability of default is high, and also it's high relative to the recession indicator. So it was showing quite a strong value in the early part of 2016, hadn't been giving a signal, maybe slightly negative signal during all of, or most of 2013-14. So that signal, as we said, was quite strongly positive here. It was also strongly positive back during the sort of the GFC period, and also back in the early 2000s. So it's now gone to more to a neutral reading. Thank you.